Imagine being able to predict the highs and lows of the stock market with a level of confidence that allows you to sleep soundly at night, knowing your investments are on solid ground. This might sound like a financial fantasy, but Howard Marks, a luminary in the world of investing, offers insights that bring us closer to this ideal. Marks' profound understanding of market cycles provides investors with the tools to navigate the often turbulent waters of financial markets. His teachings emphasize the importance of recognizing cyclical patterns, understanding the psychology driving market behaviors, and making informed decisions to maximize returns and minimize risks. Join us as we explore Marks' invaluable wisdom, revealing how a deep comprehension of market cycles can transform your approach to investing and position you for long-term success. Understanding market cycles. At its core, a market cycle refers to the various stages that an asset or market undergoes over time. These stages typically include growth, peak, decline, and trough. Marks emphasizes that recognizing these cycles is crucial for investors because it allows them to anticipate changes and adjust their strategies accordingly. He famously said, "You can't predict, but you can prepare." The phases of market cycles. Growth phase. This phase is characterized by increasing optimism, rising asset prices, and economic expansion. Investors are confident, and there is a general sense of prosperity. Marks points out that during this time, the risk of investing may appear low because returns are strong and losses are rare. However, he cautions against complacency. The riskiest thing in the world is the belief that there's no risk. Peak phase. At the peak, the market exhibits extreme optimism. Asset prices are at their highest, and speculative behavior is rampant. Marks warns that this phase is often accompanied by a disregard for risk and a belief that the good times will never end. He advises vigilance and prudence, noting the biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Decline phase. Following the peak, the market begins to decline. Prices fall and pessimism starts to take hold. This phase can be triggered by various factors such as economic downturns, changes in interest rates, or geopolitical events. Marks highlights that during this phase, investors often react with fear, leading to panic selling and significant losses. His advice? Resist the temptation to sell in a panic. Hold on to your convictions. Trough phase. At the trough, the market hits its lowest point. Pessimism is widespread, and many investors are disillusioned. However, Marks views this phase as an opportunity. He suggests that this is the time to buy, as assets are undervalued and the potential for future gains is high. The time to buy is when there's blood in the streets, he reminds us, quoting the famous adage attributed to Baron Nathan Mayer Rothschild. The importance of psychology in market cycles. One of the central themes in Marks' teachings is the role of psychology in investing. He argues that market cycles are driven more by investor behavior than by economic fundamentals. Fear and greed are powerful forces that can lead to irrational decision-making. Understanding these psychological drivers is key to mastering market cycles. For example, during the growth and peak phases, greed can lead investors to take on excessive risk, chasing high returns without considering the potential for loss. Conversely, during the decline and trough phases, fear can cause investors to sell at a loss, missing out on the recovery. Marks advises investors to remain level-headed and avoid being swayed by the emotional highs and lows of the market. Practical application, a case study. To illustrate how understanding market cycles can benefit investors, consider the case of the housing market in the mid-2000s. During the growth phase of the early 2000s, housing prices soared as low interest rates and easy credit fueled a boom. Investors were optimistic, and many believed that prices would continue to rise indefinitely. However, by 2006, the market had reached its peak. Prices were at unsustainable levels, and the first signs of trouble began to appear. Marks would have advised caution at this stage, recognizing the signs of an overheated market and the potential for a downturn. In 2007 and 2008, the market entered the decline phase. Housing prices plummeted, and the financial crisis ensued. Panic selling was widespread, and many investors suffered significant losses. Marks' advice to resist the temptation to sell in a panic would have been particularly relevant here, as those who held on to their investments eventually saw a recovery. By 2009, the The market had reached its trough, prices were at their lowest, and pessimism was rampant. However, this was also a time of opportunity. Investors who bought during this phase, recognizing that assets were undervalued, were well positioned to benefit from the subsequent recovery. Conclusion: Howard Marks' insights into market cycles offer a roadmap for navigating the complex world of investing. By understanding the different phases of the cycle and the psychological factors that drive investor behavior, we can make more informed decisions and avoid the common pitfalls of emotional investing. Marks reminds us that while we can't predict the future, we can prepare for it by staying disciplined, remaining aware of market cycles, and always keeping an eye on the long-term horizon. As we journey through the ever-changing landscape of financial markets, let Marks' wisdom serve as a guiding light. Remember his words: "You can't predict, but you can prepare." By doing so, we not only increase our chances of success, but also gain the confidence to navigate whatever the market may throw our way. So, the next time you find yourself in the midst of a market cycle, take a step back, remember Marks' teachings, and approach your investments with a clear mind and a steady hand. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.